In this week's video, we'll review the latest charts and data to help us answer the question, are the most important market trends flipping before our eyes? We'll be moving quickly, so feel free to use the pause button on your video player. As we go through the charts, we'll be focusing on these 5 key bullet points to see where we stand at week's end relative to these 4 key questions. And right out of the gate, the entire video is being recorded after the close on November 18th. The market skyrocketed last Thursday when it got a better-than-expected inflation report and received a second better-than-expected inflation report this week. Having said that, we might not expect the weekly total for the S&P 500 to be a decline this week of 27 points. The NASDAQ 100 dropped 140 points. If the long-term trends are going to flip, first, we need to see some intermediate-term trends flip. 50-day moving average for the S&P 500, 50-day moving average for the NASDAQ Composite, the 50-day moving average for IEF, which is tied, of course, to interest rates. All of these as of the close on Friday, November 18th. NASDAQ Cloud during Friday's session, there's nothing here that says the weekly trend is about to flip, at least relative to probabilities. Nothing definitive either way near the key 200-week moving average for the NASDAQ Composite. And on the daily chart, we're pausing or stalling down here near a key volume by price range. From a bullish perspective, to help us keep an open mind about a new bull market and better than expected outcomes, this is a monthly chart of the Dow Jones Composite Average. You can pause your video player. This look relative to the 40-month moving average in red and the 10-month moving average in blue, described by these 3 points here, it's extremely rare and for the most part speaks to a strong long-term trend. It's only happened 2 times going back to 1934, the COVID low, and recently in 2022. S&P 500, same concepts going back to 1933, only happened 2 previous times, 1990 and the COVID low. If you know your market history, really good things happened in those 2 cases. It's only happened a total of 3 times going back to 1933, and 2 of them are clustered here. That's somewhat similar to what happened in the 1990 case. So the 1990 case checks the boxes. The 1987 case is similar to COVID. It can't check the boxes, but it's very, very close to checking all the boxes. And you can study the historical charts, but it's very, very difficult to argue anything other than this tells us we still have a strong long-term trend based on the chart in front of us. And in a double dip case here, similar to the COVID low and similar to the current pullback in the 1990 case, really, really good things happened from the closing low on the daily chart in October of 1990 to the end of 1997 up here. The S&P 500 tacked on an additional 229%, the NASDAQ 383%. Simply telling us to keep an open mind about better than expected outcomes, especially if the markets can make a stand near the 40-month moving average. Also noteworthy, in the 1990 case, you came back and you undercut the high prior to the 1987 crash. You retraced about 50% of this A to B move when you came down here. And when you undercut this high here, you ended up retracing about 38.2% of this A to B move when you hit this low here. Thus, hypothetically, in the present day, the COVID high using the monthly chart is somewhere in the neighborhood of 3240 here. If we came back to the 38.2 of this A to B move here, that sits right around 3,000. So if something similar happened, 3,000, 3,300, 3,400, and 3,675 are all within the realm of historical possibility. It's a weekly chart during Thursday's session before the close. It's the 40-week moving average here, a good reference point. And if you want to keep an open mind about the rally continuing, even under a counter-trend rally scenario, these levels up here are quite a bit higher relative to where we are this week. If this is a counter trend move, this A to B move here, this would be B, The 61.8% retracement sits approximately in the 3,200 range. Volume by price also down in that general area. These are the average and median bear market levels that we've covered in the past. Thus far in the present day, a pretty tepid drawdown relative to history. Median recessionary bear market hypothetically could take you down under 3,000. The average recessionary bear market could take you under 2,800, all hypothetical relative to this starting point up here. If you look at the LEIs historically and you look at the yield curve and you look at this 3,200 retracement level here and volume by price in here, you can understand why we and others are pointing to the possibility that the S&P 500 might not trough until it reaches 3,000 or 3,300-ish. And remember, the S&P was down 10% or more at the end of August. Historically, the average and median additional drawdown hypothetically would take you to approximately 3,200, inside that 3,000 to 3,300 range. Important volume by price range here also coincides with those numbers. Dow Jones Composite during Friday's session. See, for the most part, we still have a full-bore bearish look, and we'll learn something up in this area here. Dow Jones Industrial Average during Friday's session. This, relative to the prior trend, this cluster in here looks better than this. This was rejected immediately. This was rejected for the most part immediately. Similar situation up here. So the good news is we're trying to consolidate above these downward sloping trend lines. The concern would be shorter term momentum relatively weak in here. So we'll learn something either way, most likely in the coming sessions. And you may remember from the cloud analysis, the cloud can act as resistance in the weekly Dow Jones Industrial Average chart right in that area of potential resistance. You may remember after the June low, we said this was a subtle and improving look on a breadth chart. This is also subtle, and it looks a lot more concerning relative to this look in here. This may improve soon, it just hasn't improved yet. During Friday's session, NASDAQ 100 weekly cloud batting 5 for 5 with the bearish boxes. However, still making a stand near an upward sloping 200-week moving average, which would be a very, very logical level for the market to reverse. We'd really prefer to move away from it rapidly, but this is a nice looking candle here from last week. 50-day moving average down, 200-day moving average down. That speaks to this question here relative to trends. And thus far, NDX has not been able to clear any of these levels in here, which represent potential resistance. Even if this is a counter-trend rally, with the key word being if, because we don't know that, this potential resistance up here says we could still see more upside, and this downward sloping trend line also has white space between price and the trend line. Also, for now, still making a stand near an upward sloping and very important 200-week. You can find a little bit more about this chart on our Twitter feed at Shivako Capital. Spelling here gives us some guideposts. 42.38 up here based on volume by price. Simple 200-day moving average around 40.70. Got a trend line up here also somewhere in the vicinity of, let's call it 41.50-ish. And we still haven't cleared this trend line here that sits somewhere in the neighborhood of 40.70. Potential pivot resistance at 40.21 here and 41.70. If the S&P 500 can clear these levels, the longer above, the more relevant it becomes. And the more we drift away from this type of look or this type of look or this type of look, the more relevant it becomes. Right now, hard to make an argument it looks all that much different. RSI down here, hovering around 59-ish still. If you're a bull, you'd like to see that tick a little bit higher next week. Similar situation here. We're near a key battleground. Even if this is a counter trend move, can we envision more upside? Absolutely, positively, yes. This is 4,200 up here. And these bars come in at even higher levels, potential resistance. We'd really like to see this 30-week moving average flatten out and then turn up. We just don't have it yet, but we're above the 30-week moving average, and that's a start. We've been there before, The longer you hang out near the 200-week moving average or the 50-month moving average, really the less impressive it becomes, because this is 2008 here. You can see where PPO is here, PPO at a similar spot in the present day. So the fact that we've held at 200 weeks and or 50 months doesn't mean a lot unless we can move away from those levels. But it is a good step. Quite a bit better than blowing right through it. So it's to be determined whether we've got to look like this, or look more like this, or look like this, or this. S&P 500 weekly with the 30, 40, and 50-week moving averages. Is it possible this is a counter trend? Sure, it's possible. If it's the end, right here in 2003 after a retest, or the end, similar to this point here after the major low that occurred in October of 2011, or the double bottom in 2015, 2016, or the COVID low. If a new bull market has started, we know green moving average up here, 50-week, will eventually be exceeded as it was in every one of those cases. Right now, that sits around 41.58. That also represents an area of potential resistance. And remember the bullish 1990 case that is similar to the present day in a lot of ways, including the Fed. You can see you pop right above these moving averages. And notice there's a big difference. Look how tight they are here relative to this look in here. This, the white space between the MAs, looks more like this in here, or this in here, relative to this in here, or even this in here. We'll see how it unfolds. Weekly MACD and PPO still below the zero line. What does that say? It favors this being a counter trend within an existing and already established downtrend. What once acted as support may now act as resistance. What once acted as support may now act as resistance. We'll learn something either way. You really don't need a volume by price bar or a volume weighted average price line to understand these areas up here represent potential strong resistance. And that also means if you can get to the other side and stay there, it's very meaningful. Equal weight with the 200-day simple moving average shown in red. How about this question here? Interest rates. It's a 10-year yield. All of these charts are as of the close on Friday, November 18th. Let's start with this. This is a peak here on the daily chart, a high here. This is a pullback. And this is a trend on this time frame that looks like it's weakening and rolling over. So keep that in mind. It becomes more meaningful if the 10-year yield gets below the cloud. Red and blue and green all get below the cloud, and the cloud flips to red. That may happen, but right now the cloud is acting as potential support, possibly similar to this look here. Any significant cracks relative to the trend on the weekly? None. It still checks all 5 of the bullish boxes. And even over the last 3 sessions or so, the 15-minute chart is moving in a manner that says this potential support may hold. We'll see how it unfolds. Weekly 2-year yield checks all the bullish boxes 5 for 5. This is as of Thursday's close, the big chart. 2-year yield was up on Friday, so it didn't do anything to change any of this here. A couple of Bloomberg articles that are worth reading. They tell us to keep an open mind about rates going higher than currently expected. Is the bond market listening to the Fed? It's hard to say no when we look at the facts. This is the range between 5% and 6%. All of these levels in here. That's expectations, market expectations in June of next year. So that speaks to the terminal rate. Expectations, how high could rates go? Well, those expectations have been rising. When we compare those expectations between 5% and 6%, In all of these increments here, the odds of us being up here are higher today than they were 1 day ago, higher today than they were a week ago, higher today than they were a month ago. That aligns with this on Friday, and that aligns with this on Thursday. Have the stock market bulls, made some progress? Absolutely, positively, yes, if you zoomed in on this chart here. There's a 10-2 yield curve data here going back to 1990. You can see you've only been down here one other time. That's the dot-com bust bear market. Down there again. This is a recessionary case here as well. And as we've mentioned before, inflation and interest rates are a global problem. If the economy was going to avoid a recession and a new bull market was starting, this is really not the look that we would expect. If you're a stock market bull, you'd prefer to see a look like this. At the moment, this is during Friday's session at 3 p.m. roughly, this looks like a bullish breakout, and now it looks like potentially a failed breakout. Keep in mind, it took quite a while to decide which way to go here. No discernible improvement on the weekly cloud chart for QQQ 2:32 p.m. November 18th. What does this look here relative to the 200-week moving average tell us about inflation expectations, interest rate expectations, and Fed expectations? Exact same questions here. This is growth versus value during Friday's session, 50-day down, steep slope, 200-day down, steep slope. The Dow and value stocks have been leading during the current rally. As we mentioned before, we'll learn something if they can break out and get to the other side. This is VTV, a value ETF, DeMark exhaustion count. DeMark charts and indicators are proprietary tools from Market Studies LLC. 913, work like a charm here at the October low. We have the same 913 in the other direction on the daily chart. This is Friday's session here. This is potential trend exhaustion, bearish exhaustion, speaks to odds. Now this is potential bullish exhaustion with potential resistance here at the teal diamond. If we can negate this 13, we'll learn something about bullish probabilities. Here's the risk-on look here. This is the look in the present day. Here's the 50-day in blue in the present day. If we can get to the other side and stay there, we'll learn a lot about new bull market probabilities. Not there yet. Still intriguing from a bullish perspective. There's still enough similarities between the present day and the 1962 case to keep an open mind about much better than expected outcomes. Same set of moving averages here. Higher low, lower low. That would be a negative on this side. But these are tighter moving averages here, so if you can clear these moving averages, that would be a good sign in the present day. From this look here in 1962, we basically never looked back. And we can all envision the catalyst to get us to the other side. This topic right over here. Still prefer to see this RSI number in the present day come up. Extended trend, XLK divided by SPY, sometimes it just goes sideways. Similar situation here, SP low volatility, extended. You need to consolidate your gains, up 0.9% during Friday's session at 226. SPLV divided by SPY. No discernible improvement on XLK divided by SPY weekly cloud. No discernible improvement in terms of the slope of the 200-day and the 50-day for the same ratio. Weak momentum in the ratio here in February of this year. Similar look in the present day. Just a different way to look at a ratio we've already covered. Friday the 18th, 2 p.m. Eastern, but we did close below the red. Thus, from a probability perspective, this applies. Still have some work to do here. We have two better than expected inflation reports in our back pocket, and yet defensive XLP beat SPY, or was beating SPY at 2 p.m. Eastern time on Friday, November 18th by 2.2%. Defensive staples divided by more aggressive discretionary. Here's your look here in 2007. So this is the financial crisis look here. This is the 50-month moving average. Here's the ratio here. Here's the same 50-month moving average, and here's the same ratio. Does this look different from this period here? During Friday's session, did it improve? No. 2 p.m. Eastern, XLY divided by XLP. Full bore bearish look for the most part for the ratio, down over 1%. Can it improve rapidly? Sure it can. We know that. Hasn't improved yet. Monthly look, financial crisis, present day look. It's a daily cloud Thursday session. Progress for the stock market bulls, you bet ya. But it's hard to make an argument that this look in here is discernibly different than this counter trend look here that ended in August, or this counter trend look here that started in February and held near the cloud in early March. Trend change? No. More vulnerable? Yes. Should we be more open to a trend change? Yes. But we have to ask ourselves, what does this look here, full bore bullish, as of the close on November 18th, say about future expectations for inflation, Fed policy, and or interest rates? October 27th chart that we covered in a past video, dollar with an extended look back then? Yes. Any significant shift to the weekly trend? This is UUP down here, 2:15 p.m. on Friday. Not yet. Look at these bearish bullet points here, and then look at IEI 3 to 7 year Treasury bond ETF. What does this say about rate expectations? Full bore bearish. HYG, no significant improvement. That's high yield bonds. And the clouds are really representing the same thing that we can see here with the moving averages. This is the simple 8-day all the way out to the 250-day here. You can pause your video player here. JNK, high yield bonds, speaks to future economic outcomes, recession risk, default risk, counterparty risk, liquidity risk, observable improvement near the major low in March of 2009, observable improvement after the major low in February of 2016. We just don't have any of that observable improvement this week. A zoomed in look here. If you're a stock market bull, this is a mutual fund, a proxy for JNK. This is the look we want on the weekly chart. If we knew with 100% certainty that inflation had peaked, the Fed was about to stop, and interest rates were about to fall, and we had two choices. We could buy JNK, yielding roughly 5.6%, and lock in that yield by buying it today, or we could buy BIL and lock in a yield of 0.54 hypothetically. This is during Thursday's session. Here's the interest here in this yield. Here's the interest here in this yield. Here's JNK BIL weekly. This is the look we want to see for a new bull market, the look we want to see for a major low, the look we want to see after the Christmas Eve 2018 low in the S&P 500, the look that we want to see in JNK divided by BIL after the COVID low. This is the look that we have during Thursday's session, 0 for 5. Having said that, keep in mind, the downtrend could remain intact, but there's a lot of white space between price and the cloud. It says even under an ongoing bear market scenario to keep an open mind about an ongoing counter trend rally. This is a weekly chart here. Do we have some improvement on the daily? We do, but nothing significant yet. Take these three questions here and then examine these two charts, one of them being monthly, one of them being weekly, both of them as of Friday, November 18th. Amazon bottomed before the S&P 500. It bottomed in Q4 of 2008. Question, does this look different than anything that we've seen since that low in 08-09? Yes, it does look different. If you think it through, if the dollar was about to weaken, the Fed was about to shift, and inflation was about to come down, would this chart look like this? If you're a stock market bull, all things being equal, you'd prefer to see EMB weekly get above that 30-week moving average. It may happen very, very soon. Hasn't happened yet. We'll learn something from the leaders, some of the leaders for the current rally here. This is during Thursday's session. This still may tell us something about damage that is yet to come. If we bottomed here and the bottom's in, it would be one of the shallower bear markets in history relative to average and median outcomes. The weekly S&P 500 chart improved after the low here. It improved after the major low here. It improved after the major low here. It improved after the major low in 1962. It improved after the major low in 1990. Never looked as bad in 2010 and 2011 relative to the look in the present day. It improved after the major low in February of 2016. But as of October 27th, it hadn't improved. And during Friday's session, still a lot of work to do. It may improve very, very soon. Hasn't done it yet. The cloud up here tells you a push to 4,200, 4,150-ish, well within the realm of reason, even within the context of a counter-trend move. There's always another side in the stock market. How can we say that? Well, the S&P 500 made a new all-time high in January of this year. So in every single historical case, there was another side. The question is, how long does it take and how much pain between point A and point B? It's very, very easy to get discouraged about the bond market and the stock market. JP Morgan Asset Management, they're saying after declines like what we've seen now, valuations look better, the 60-40 portfolio could produce an averaged annualized return of 7.2% over the next 10 to 15 years. That sounds pretty good. And if you can do that with a 60-40, maybe it's better in the stock market. It's very, very easy to get pessimistic and miss the turn. It's very, very easy to get pessimistic and miss the turn. If you go back and look at the VIX in 2008, a sleepy VIX tells us we should not forget about this data here. And we should not forget about this topic here. Average additional loss after similar inversions historically, painful, over 40%. Additional loss. You absolutely should keep an open mind about inflation dropping, possibly rapidly. Open mind about a wide range of outcomes. The charts we just covered provide a lot of insight relative to the probabilities tied to these four questions. Is there some improvement here? Sure there is. 2 reports. Is there some improvement here? Yes. Most likely they're going to raise by 50 basis points. Some improvement here. There's weakness on the daily chart. Some improvement here. We're in a counter-trend rally at least. A counter-trend rally until proven otherwise. It's important to keep in mind, in the early stages of every new bull market, it always looks like a counter-trend move. But right now, the moves that we see, they look like counter-trend moves. That may change very, very soon. Even if this is a counter-trend rally, we could push to 4,100. You can even make an argument we go all the way to 4,300-ish. Risk appetite as of the close on Friday, November 18th is still concerning, and we just went over that. However, risk appetite really didn't look that great in late June or early July, and then it picked up and the market rallied all the way into mid-August. So that could happen in the present day. It just hasn't happened yet. More vulnerable, no shift yet. Our leaders, value, and the Dow Jones Industrial Average, they're pushing the counter-trend envelope, telling us to keep an open mind about a new bull. Relative to history, there's no question. The odds of a recession occurring in the next 12 to 18 months are high. And if we go into a recession, history says earnings typically take a big hit. Thus, it's possible we're about to enter the stage where the news on earnings and economic news starts to spook the market. We're not quite there yet. And we may never get there, but history says most likely we will. And none of this has changed in terms of possibilities, nor has the timing relative to history. And if we do go into a recession, at some point that you would think there would be an opportunity in bonds as the longer end of the curve starts to look ahead. And historically, at a minimum, there's a good chance that bonds should outperform stocks if we're going into a recession and the market takes another leg down. You can look at our Twitter feed. this is still a big problem. The Fed is still trying to talk the market down. There's a reason we have the expression, don't fight the Fed. Now, this can change quickly if we see better inflation data walking forward, but it hasn't changed yet. They haven't changed their script, still talking about the mistakes from the 1970s. And it's easy to understand how this may be a new bull market. Inflation data improves. We've seen some improvement. However, the charts that we're looking at, the charts that we just covered, they're not jumping up and down and saying we're about to return to a low interest rate environment and an environment where your leaders are tied to low rates. Again, talking about the charts in front of us. It's really important that we respect all scenarios, even ones that are hard to comprehend. Inflation and rates peak, traditional new bull market has started. Sticky inflation, rates higher than expected, the Fed's still a problem. More of a typical recessionary bear, you go down somewhere between, let's say, 3,000 and 3,400. But a hybrid case also needs to be respected, where your current leaders, the Dow, value, energy, continue to lead. The destinations that we covered 2 weeks ago, still highly relevant. It's possible a counter-trend rally could take us to 4,100, 4,200, even near 4,300. And then it's possible that we could backtrack, make lower lows in the vicinity of 3,000. A push higher really is only relevant to a longer-term investor if it's a new bull market. Have to understand our time frame. And it's really an excellent market to be a tape reader. Everything gets better if we shift from risk aversion to acceptance of risk. We really just don't have that yet. Have some examples, but they're not broad. We just covered the message from the tape and history, and the facts that we've been covering now for several weeks or months tell us that we should be open to a wide range of outcomes, and we should be extremely agile. Thus, we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.